Medha, hi, good morning. First, a word on the Chinese PMI data that we saw yesterday. Clearly doesn't seem like things are out of the wood, especially for the Chinese economy.
Well, it's interesting times for China right now. The PMI has hit a 6-year low. There's a lot of concerns about what the macro data is telling us. But look, on the ground here in Asia, in Hong Kong, we're well aware of the fact that China is slowing down. But it's not a disaster. It's not exactly melting down. Yes, we're talking about a new norm of growth, maybe 5 to 6%, but it's still a very good environment for certain companies to grow in. And that's what we are focusing on. Now, the recent run-up in the Chinese markets, what you saw, sort of the sharp upturn and then the sharp downturn, what that has made happen is that valuations of both the A shares and importantly, the Hong Kong listed H shares have come off to very attractive levels now. So we think that from a valuation perspective, some of these companies are looking quite attractive. So there are concerns given what's happening globally. There will be volatility in the short term, but long term, there are certain opportunities from a bottom-up perspective.
Because when I look at India, India has suddenly become a great macro story. Balance sheet concerns are over, macro concerns are behind us. The conversation on India, frankly, has moved beyond fiscal deficit and inflation. So what happens to Indian markets now? There's a lot of global liquidity, growth is precious, growth is scarcity. Do you think that a lot of flows will automatically migrate back into Indian stocks?
See, when we look at India today, it is really a relative outperformance trade, okay? Whenever we've seen uncertainty with respect to China, investors are playing a kind of barbell approach. So almost like China's pain being India's gain. So we've seen some of those flows from emerging markets, which flowed out of China, coming into India. But at the same time, one cannot ignore the fact that India is the most overowned trade today. So, short term, there could be some concerns. I mean, from us on the ground, I was at an investor conference in Mumbai 2 weeks ago. And what really came out is this short-term concern of below normal monsoons. And that can have an impact on rural consumption. And these kind of stories are slowly beginning to filter their way through. So short term, yes, there will be volatility because one or two local factors, and some of the global uncertainty that we see. So this market could trade zigzag. But what's important for India is really for the central bank to make sure that investors are aware that it's on a monetary loosening path. So we want to see more interest rate cuts. We would like to see more sort of reform-oriented announcements. And it's really about the implementation of reform now more than just talk. And that would really drive the India story going forward. But in the short term, expect more volatility. This could, there could be a risk here because of that as well.
Talking about the short term, I'll scale it to the near term, Medha, and come next week, all eyes would be on Raghuram Rajan and what he chooses to do in the credit policy. What is your own sense of how much elbow room does the RBI have to cut interest rates? Because the clamor is now getting to a 50 basis point cut.
Yeah. So, when we look what's happened globally with the Fed, really the pause that the Fed has provided gives the RBI room to go ahead with cutting rates. A 25 basis points rate cut has been generally sort of accepted by all investors and all sort of fingers point to that. But the jury is still out there in terms of timing, in terms of the magnitude of the rate cuts. What's important is that for this cycle to continue, and we want to see more easing in terms of rate cuts because it's really about next year, not about this year for corporate India, next fiscal year, where we need to see an earnings rebound. We do need to see more public investment as well. So it's a combination of factors, although in the short term, it's really more decisive rate cuts which should drive the way ahead.
Do you think it's time to now bid goodbye to some of the consumer and some of the defensive names? If I look at the recent performance in some of the consumer names, Indian consumer stocks, the HULs, the ITCs of the world, they are no longer market outperformer. They're falling more than the markets. Do you think that trade is over now? Money has been made. It's time to move on.
I think when you look at the consumer names from a regional perspective and include Indian names there, what stands out is that valuations are very expensive. Okay, on the one hand, if you see a downturn in rural demand and rural consumption, you could see some margin impact. So as a result of that, from our perspective in Fidelity, our fund managers are actually underweight some of the consumer names where we think valuations have run up. What we remain positive is on still some of the private sector banks, We like some of the healthcare names. We like, plays which are geared to infrastructure. But importantly, I was just back from Singapore last night, and we just hosted a big conference for our wholesale clients where the theme was about disruption and innovation. So we like companies which are true innovators, which can be beneficiaries of disruptions. So this could be in the media sector, in the telecom sector. Important for India, it's really the healthcare companies which have moved up the value chain from branded generics to some of the biosimulator drugs that we see today. So that is a very sort of key theme that's emerging within our portfolios today.
So good chatting with you. Thanks much for taking the time out and speaking to us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.